Your purchasing power is being transferred to Asia through a price gap that should not exist. On February 2nd, 2026, physical silver in Shanghai traded at $79 per ounce. The COMEX futures price in New York closed at $79. But to remove silver from Shanghai vaults, buyers must pay a 13% value-added tax. The true Shanghai price after tax, $89.27. Add $2 for air freight insurance to ship 1,000-ounce bars from London or New York to China. The arbitrage profit, $8.27 per ounce, on a commodity with transparent global pricing. This spread has existed for 6 consecutive weeks. In a functioning market, arbitrage opportunities disappear within hours. Traders buy cheap, sell expensive, and prices converge. The fact that an $8 gap persists means the system that is supposed to equalize prices has broken. This arbitrage failure has appeared exactly 3 times in modern silver history. March 1980 during the Hunt Brothers squeeze, May 2011 during the ETF mania, and January 2026 when lease rates hit 8%. Each time, Western vault inventories drained to Asia. The question is not whether silver will continue flowing east. The question is what happens when Western vaults run empty and industrial users in Europe and America cannot source metal at any price. I'm John Agee, and this is the Collapse Files. Between January 4 and February 2, 2026, the Shanghai Gold Exchange silver premium over COMEX fluctuated between 10 and 29%. The premium reached 29% on January 30th, when COMEX silver crashed from $121 to $78 in a single session, while Shanghai prices remained elevated. After accounting for the 13% VAT required to withdraw silver from Chinese exchanges, the effective premium was 45.8% at its peak. This represents $36.22 per ounce on a metal trading at approximately $79. Add shipping and insurance costs, and physical bars were worth $40 more delivered to Shanghai than stored in New York. The Shanghai premium is not the only indicator of dislocation. Silver lease rates in London spiked to 8% in January 2026. Normal lease rates run between 0.3 and 0.5%. A lease rate is the annual interest charged to borrow physical silver. When institutions pay 8% to borrow metal for short-term delivery needs, it signals acute shortage. The last time lease rates exceeded 7% was October 2025, when rates briefly hit 32% before easing. The current 8% level has persisted for 4 weeks, indicating structural tightness rather than temporary stress. The futures curve entered deep backwardation in December 2025 and remained there through January 2026. Backwardation occurs when spot prices trade higher than future delivery contracts. On January 15th, spot silver traded at $288 above the March futures contract. This is the largest backwardation since 1980. In normal markets, futures trade at premiums to spot to account for storage, insurance, and financing costs. The inversion means buyers will pay more for immediate delivery than for metal promised 3 months forward. This behavior signals that participants do not trust future delivery and prefer possession now. COMEX inventories reflected the physical drain. Registered silver, the category available for delivery against futures contracts, stood at 38.2 million ounces on February 1, 2026. This compares to 62 million ounces in December 2024, a decline of 23.8 million ounces in 13 months. Total COMEX inventories, including eligible metal not designated for delivery, reached 299 million ounces. But eligible silver cannot be delivered unless owners choose to reclassify it as registered. The gap between total inventory and deliverable inventory creates the illusion of ample supply. On January 24, 2026, COMEX experienced delivery demand for 33.45 million ounces within a 7-day period. This exceeded registered inventory, forcing the exchange to facilitate transfers from eligible to registered status. The scramble to source metal revealed how thin actual deliverable supply had become. If demand for physical delivery persists, the registered category will deplete rapidly. Once registered inventory falls below open interest in expiring contracts, the exchange faces a supply crisis. China implemented export controls on silver effective January 1, 2026, reclassifying the metal as a strategic material. Only 44 licensed firms can export silver, and each must meet minimum production thresholds of 80 tons annually and maintain credit lines exceeding $30 million. China accounts for 60 to 70% of global refined silver exports. The restriction removes approximately 35 million ounces from the international market annually. The supply reduction hits at precisely the moment when inventories are already depleted and lease rates are elevated. The United States designated silver a critical mineral for the first time in 2025. Russia announced plans to purchase silver for national reserves. Turkey and Poland accelerated central bank buying. These sovereign purchases add demand that is price insensitive. Governments do not sell during price corrections. They accumulate for strategic reasons unrelated to market timing. This demand layer sits beneath industrial and investment demand, creating a floor that did not exist in previous cycles. Industrial demand for silver exceeded 600 million ounces in 2025, representing approximately 55% of total supply. Solar panel production alone consumed 200 million ounces. Electric vehicle manufacturing used 90 million ounces. Electronics and semiconductors required 250 million ounces. Unlike gold, silver is consumed in industrial applications and does not return to the market. Each solar panel permanently embeds approximately 20 grams of silver. When panels degrade after 25 years, silver recovery is uneconomic. The metal is effectively destroyed. Investment demand through ETFs and physical purchases added 180 million ounces in 2025. Total demand of 780 million ounces exceeded mine supply of 850 million ounces after accounting for recycling. The deficit was met through drawdowns of above-ground inventories. 5 consecutive years of deficits have reduced inventories to multi-decade lows. The World Silver Survey estimates that free-floating silver available for purchase now totals less than 1 billion ounces. At current consumption rates, this represents 14 months of global supply. The silver market operates on 3 layers: physical metal, futures contracts, and financial derivatives. At the base is mine production and refined bars stored in vaults. Above that sits the futures market, where contracts represent claims on future delivery. At the top are ETFs, options, and over-the-counter derivatives. The system functions when prices across all 3 layers remain aligned through arbitrage. It fails when price dislocations become too large for arbitrage to correct. Arbitrage relies on the ability to move physical metal between markets. If Shanghai pays $40 more than New York, arbitrageurs should buy in New York, ship to Shanghai, and pocket the difference. This buying in New York raises prices there. Selling in Shanghai lowers prices there. The spread narrows until it equals the cost of transportation and insurance. At that point, further arbitrage is unprofitable and prices equilibrate. The current dislocation exists because metal cannot move fast enough to close the gap. London and New York vaults have limited deliverable inventory. Shanghai buyers demand immediate delivery. Air freight capacity for heavy metals is constrained. Lead times to refine doré bars into 1,000-ounce good delivery bars run 4 weeks. By the time metal reaches Shanghai, the premium may have shifted. The arbitrage opportunity exists on paper but cannot be executed at scale in physical reality. The entities trapped by this breakdown are industrial users, commercial shorts, and ETF authorized participants. Industrial users in Europe and America cannot source silver at COMEX prices because physical premiums have risen to $10 to $15 over spot. They must either pay the premium or halt production. Many manufacturers have shifted to just-in-time inventory management to minimize working capital. This strategy fails when spot markets cannot deliver metal reliably. Commercial shorts are traders who sold futures contracts at $100 and now face potential delivery obligations at $79. They profit from the price decline but lose if they must deliver physical metal they do not own. To cover shorts, they must buy metal in the physical market at premiums that erase paper profits. If they cannot source metal, they face default and contract settlements in cash rather than metal. Cash settlement breaks the connection between paper and physical markets. ETF authorized participants are the financial institutions that create and redeem ETF shares. When investors buy silver ETFs, authorized participants purchase physical metal and deposit it with custodians. When investors sell ETF shares, authorized participants withdraw metal and sell it. This mechanism keeps ETF share prices aligned with the value of underlying metal. If authorized participants cannot source metal to create new shares, ETF prices can trade at premiums to net asset value. If they cannot deliver metal for redemptions, ETFs may suspend redemptions or settle in cash. The COMEX paper-to-physical ratio quantifies the leverage embedded in the system. Open interest in silver futures represents approximately 370 ounces of paper claims for every ounce of registered physical inventory. This ratio assumes that only 1 to 2% of contract holders will demand delivery. If 5% demand delivery, registered inventory depletes. If 10% demand delivery, the exchange cannot fulfill obligations without massive transfers from eligible to registered status or emergency imports. The historical precedent for this leverage structure comes from fractional reserve banking. Banks operate with reserves equal to 10% of deposits, working because depositors do not all withdraw simultaneously. Silver futures operate on even thinner reserves at 370 to 1 leverage, meaning COMEX holds reserves equal to 0.27% of claims. This works only if 99.73% of contract holders settle in cash rather than demand metal. That assumption held for decades. Speculators had no interest in taking delivery of 5,000-ounce bars. Industrial users secured supply through long-term miner contracts. But when China restricts exports and governments declare silver strategic, industrial users lose confidence in traditional channels. They turn to futures markets for physical delivery, overwhelming a system designed for financial settlement. Vault logistics compound the problem. Registered silver sits in warehouses in New York, Chicago, and Delaware. Moving 1,000-ounce bars to Shanghai requires coordination among vault operators, shippers, insurers, customs, and receiving vaults. The process takes days to weeks, depending on air freight availability. During that time, prices can move significantly, eroding arbitrage profits. Emergency imports face obstacles. London faces its own supply constraints. Swiss refiners report backlogs of 4 weeks. Shipping from Asia to the West runs counter to current flows. Vault operators are incentivized to hold metal rather than sell at depressed paper prices when physical premiums are elevated. The collective result is that the mechanism designed to absorb delivery demand through flexible sourcing has become rigid and unresponsive. The Shanghai Premium over COMEX provides the clearest measure of system stress. On January 30th, Shanghai silver closed at $101 per ounce. COMEX settled at $78. The raw premium was $23, or 29.5%. Adding the 13% VAT brings the effective premium to 45.8%, or $36.22. This exceeds the largest premiums recorded during the 2011 silver peak, when Shanghai traded 12% above London at maximum dislocation. The January 30th data point is particularly significant because it occurred during COMEX's collapse. When New York prices fell 31% in a single session, Shanghai prices declined only 8%. This divergence indicates that Chinese buyers viewed the COMEX move as a technical liquidation rather than a fundamental repricing. They were willing to pay $101 while New York settled at $78. The $23 gap is approximately 30% of the COMEX price, representing the largest peacetime divergence between major silver markets in history. Lease rates quantify borrowing stress. The 8% rate in January 2026 means that institutions borrowing 100 ounces of silver for 1 year must return 108 ounces, or pay the equivalent in cash. For comparison, gold lease rates in January 2026 were approximately 2%. The 6 percentage point spread between silver and gold lease rates indicates that silver faces supply constraints that gold does not. When lease rates exceed the returns available from lending other assets, it signals that silver's scarcity value has increased beyond its financial yield. The October 2025 spike to 32% lease rates lasted 3 days before easing. The current 8% rate has persisted for 4 weeks. The duration matters more than the absolute level. Temporary spikes reflect short-term squeezes that resolve through price adjustments or inventory transfers. Sustained elevated rates indicate structural shortages that require supply expansion or demand destruction to resolve. Silver supply cannot expand quickly because 70% comes as a byproduct of base metal mining. Demand destruction requires industrial users to find substitutes or halt production. Backwardation depth and duration provide additional evidence. The $288 backwardation in mid-January represented 3.2% of the spot price. For context, the entire storage and financing cost of silver typically runs 1 to 1.5% annually. A backwardation of 3.2% implies that market participants are willing to forego 3.2% returns to hold physical metal immediately rather than accept delivery in 3 months. This preference for immediate possession over future promises reflects declining trust in the paper system's ability to deliver. COMEX inventory dynamics reveal the pace of physical drain. Registered silver declined from 62 million ounces in December 2024 to 38.2 million ounces in February 2026. The 23.8 million ounce reduction occurred over 13 months. Average monthly decline of 1.83 million ounces. If this pace continues, registered inventory depletes to zero within 21 months by November 2027. Long before reaching zero, the exchange would face delivery failures because some registered metal is not available for immediate delivery due to logistical constraints. Total COMEX inventory of 289 million ounces includes 261 million ounces of eligible metal. Eligible inventory is silver stored in COMEX-approved warehouses, but not designated for delivery. Owners can reclassify eligible to registered, but they are not obligated to do so. The fact that 261 million ounces sits classified as eligible while registered inventory drains indicates that owners prefer not to make metal available for delivery at current prices. This is rational behavior when physical premiums exceed spot prices. Open interest in silver futures stood at approximately 140,000 contracts on January 31st, 2026. Each contract represents 5,000 ounces. Total open interest equals 700 million ounces. Comparing open interest to registered inventory yields a ratio of 18 to 1. For every ounce available for delivery, 18 ounces of paper claims exist. This ratio understates leverage because it excludes options, ETF shares, and over-the-counter derivatives. Including all paper claims, analysts estimate the total leverage at 370 to 1. Chinese inventories provide context for Asian demand. Shanghai Futures Exchange, silver inventories fell from 980 tons in January 2025 to 410 tons in January 2026, a decline of 58% in 12 months. These inventories represent approximately 13 million ounces. At the current pace of decline, Shanghai inventories would reach critically low levels by mid-2026. Chinese demand shows no signs of abating given government support for solar energy and electric vehicles. Industrial consumption in China exceeds 150 million ounces annually and is growing. Silver mine production has been essentially flat since 2015, fluctuating between 820 and 870 million ounces annually. New mine projects require 5 to 10 years from discovery to production. Current capital expenditure in silver exploration and development is insufficient to expand supply meaningfully before 2030. The industry faces declining ore grades, rising energy costs, and permitting delays. Several major silver-producing regions have experienced declining output. Mexico, the world's largest silver producer, saw output fall 3% in 2025. Peru, the second largest producer, reported a 2% decline. The Hunt brothers' silver manipulation of 1979-1980 offers the closest parallel. Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market through futures purchases and physical accumulation. By January 1980, they controlled approximately 100 million ounces. Silver reached $50 on January 21st, 1980. Backwardation exceeded $3. Lease rates spiked above 20%. COMEX and the CBOT raised margin requirements repeatedly and eventually imposed position limits to break the corner. The price collapsed from $50 to $11 between January and March 1980. Silver Thursday on March 27, 1980, saw a 31% single-day decline when the Hunts defaulted on margin calls exceeding $100 million. The parallel to January 30th, 2026 is striking. Silver fell 31% from $121 to $78 in a single session following CME margin requirement increases. The mechanism was identical. Leverage was flushed through forced liquidation. The 2011 silver peak provides another precedent. Silver reached $49.82 on April 28, 2011. The rally was driven by ETF inflows, retail coin demand, and industrial buying ahead of supply concerns. COMEX raised margin requirements 5 times in 8 days between April 26th and May 5th, 2011. Margins increased from 11% to 18%. The forced liquidation drove silver to $33 by May 12th, a 34% decline in 2 weeks. The 2011 episode demonstrated that exchanges will intervene to prevent delivery failures. When physical demand threatens to overwhelm paper markets, margin increases force leveraged speculators to liquidate. The reduction in open interest alleviates delivery pressure. This tool works as long as the majority of market participants are speculators rather than commercial users seeking actual metal. If industrial demand dominates, margin increases cannot eliminate delivery obligations. Industries cannot liquidate silver they need for production. What distinguishes 2026 from 1980 and 2011 is the role of sovereign demand and industrial consumption. In 1980, the Hunts were speculators. In 2011, retail investors drove demand. In 2026, governments designate silver as strategic. Solar manufacturers cannot substitute copper without multi-year retooling. Electric vehicle producers require silver for every unit produced. This demand is inelastic. Margin increases and price manipulation cannot eliminate it. The exchanges can crash the paper price, but they cannot force industrial users to stop needing metal. The British pound sterling's experience with gold provides a longer historical template. In the late 1960s, the London Gold Pool attempted to suppress gold prices to defend the $35 peg to the dollar. Central banks sold gold into the market to cap prices. The selling depleted European gold reserves. In March 1968, the pool collapsed. The two-tier gold price system emerged with official transactions at $35 and free market prices that quickly rose above $40. The attempt to maintain artificial pricing failed once physical metal drained from vaults. The mainstream narrative attributes the Shanghai premium to Chinese capital controls and VAT taxes. This explanation is partially true but incomplete. Capital controls and taxes are constant. They existed when Shanghai traded at parity with COMEX. The recent premium reflects a shift in willingness to pay elevated prices for immediate possession. Chinese buyers are expressing a preference for physical metal over financial exposure to Western markets. This preference is not merely financial. It is strategic. China's January 1st export controls formalized a policy of securing domestic silver supply for industrial use. The Belt and Road Initiative has created demand for Chinese solar panels, batteries, and electronics across Asia, Africa, and the Middle East. Fulfilling these contracts requires securing input materials. Silver is a critical input that cannot be substituted at scale. By restricting exports and tolerating high domestic prices, China ensures that its manufacturers have access to metal, even if it costs more than international benchmarks. The second-order effect involves Western industrial capacity. If European and American manufacturers cannot source silver reliably, production shifts to Asia where metal is available. This accelerates deindustrialization and increases dependency on Chinese supply chains. The solar industry provides a clear example. Western solar manufacturers pay spot prices plus $10 to $15 premiums for physical delivery. Chinese manufacturers pay higher absolute prices but have secure access. Over time, the reliable supply advantage outweighs the price disadvantage. The financial dimension involves the dollar's role as the pricing mechanism. Silver has been priced in dollars and traded on dollar-denominated exchanges for decades. COMEX and LBMA set global benchmarks. But when Shanghai consistently pays premiums and demonstrates stronger physical demand, price discovery begins migrating. If Chinese exchanges become the marginal price setters, the dollar loses control over a critical industrial commodity. This is a microcosm of broader de-dollarization dynamics playing out in energy and metals markets. The ETF structure creates hidden vulnerabilities. Most investors assume that silver ETFs hold unencumbered metal in vaults. In reality, ETFs operate through a chain of custodians, sub-custodians, and authorized participants. Metal is often leased to generate yield. Lease agreements allow custodians to lend metal to short sellers who sell it into the market. This practice is legal and disclosed in prospectuses, but most investors do not understand the implications. When lease rates spike and shorts cannot return borrowed metal, ETFs face potential shortfalls. The incentive structure favors extending the paper system as long as possible. Bullion banks earn fees on lending, trading, and clearing. Exchanges generate revenue from transaction volume. Custodians charge storage fees on allocated metal. All participants benefit from high leverage and active trading. A transition to physical-only markets would reduce transaction volume, eliminate lending revenue, and decrease the role of financial intermediaries. The industry has strong incentives to maintain confidence in paper claims, even as physical fundamentals deteriorate. Media coverage focuses on price volatility rather than structural shortages. Headlines emphasize the 31% crash from $121 to $78, but ignore the 8% lease rates and $40 Shanghai premiums. This framing reinforces the perception that silver is a speculative asset subject to bubbles and crashes. The underlying reality that industrial demand exceeds supply and inventories are depleting receives less attention because it lacks the drama of price swings and does not fit the speculative narrative. The psychological impact of the January 30th crash matters. Retail investors who bought at $100 and watched it fall to $78 in one day experienced panic. Many sold at a loss. This emotional response is what large institutions exploit. By crashing the paper price through coordinated selling and margin increases, they shake out weak hands and accumulate physical metal at depressed prices. Investor behavior also misses the significance of lease rate persistence. A 3-day spike to 32% in October 2025 made headlines and then reversed. Most participants interpreted it as a temporary squeeze that resolved. The current 4-week period at 8% receives less attention because the absolute number is lower, but duration indicates structural problems that acute spikes do not. Markets can endure brief disruptions. Prolonged dysfunction forces participants to reevaluate fundamental assumptions about market structure and reliability. The wealth transfer inherent in the arbitrage gap also goes unnoticed. Every 1,000-ounce bar purchased in New York at $79,000 and sold in Shanghai at $119,000 after taxes generates $40,000 profit. This profit comes from Western vault owners who sold metal at $79 to arbitrageurs. Those owners could have demanded Shanghai prices, but lacked the logistical capability to execute the trade. Sophisticated institutions with global operations capture the arbitrage. Smaller holders receive only the paper price. This creates a wealth transfer from distributed small holders to concentrated large players. The regulatory response lags market reality. Exchanges publish inventory data weekly. Lease rates are reported with delays. By the time officials recognize problems, market participants have already adjusted. The January 30th margin increase came after silver had already surged from $70 to $121. The intervention created a crash, but did not address the underlying physical shortage. Officials can manipulate paper prices through margin requirements. They cannot create silver bars through regulation. The arbitrage gap draining Western vaults is a liquidity event in slow motion. Liquidity events occur when assets that are presumed available become unavailable at prevailing prices. The silver market is discovering that metal priced at $79 on COMEX is not actually available at that price in physical form. To obtain metal, buyers must pay $90 in New York or $119 in Shanghai after taxes. The paper price and physical price have diverged beyond the point where arbitrage can equalize them. This divergence affects confidence in all commodity markets that operate through futures exchanges. If silver's futures market cannot deliver metal reliably, questions arise about copper, platinum, and other industrial metals traded on similar structures. The leveraged nature of commodity futures depends on the assumption that physical delivery is available when needed. If that assumption breaks, the entire system of price discovery through futures comes into question. What breaks first, historically, is the short-term lending market. When lease rates spike to 8%, institutions with short positions face unsustainable borrowing costs. Shorts must either close positions by buying metal or default on lease obligations. Buying metal drives prices higher, triggering additional margin calls and further short covering. Defaults destroy confidence in the lending market and reduce future supply of lendable metal. Both outcomes accelerate the transition from paper to physical pricing. The trust dimension extends beyond finance. Industrial users who cannot source silver reliably begin hoarding. Hoarding behavior amplifies shortages because inventory that would normally circulate becomes locked in corporate vaults. This creates a self-reinforcing cycle where perceived scarcity drives actual scarcity. The just-in-time inventory model that has dominated manufacturing for 3 decades breaks down. Companies return to maintaining larger buffer stocks, permanently removing metal from circulation. The geopolitical implications involve strategic resource competition. Silver is not merely a commodity. It is the most conductive element for electricity and heat. Technologies that define the 21st century, solar panels, electric vehicles, 5G infrastructure, artificial intelligence data centers, depend on silver. If supply constraints prevent Western nations from accessing metal, technological leadership shifts to regions that control supply. China's export restrictions are not temporary trade policy. They represent a strategic decision to prioritize domestic technology development over export revenue. The currency impact operates through gold's shadow. Silver has historically traded at ratios to gold ranging from 40 to 1 to 80 to 1. The current ratio around 50 to 1 suggests silver is relatively expensive compared to historical norms. But if silver is reclassified as a strategic industrial commodity rather than a monetary metal, the historical ratio becomes irrelevant. Industrial commodities like copper trade at ratios to gold that reflect utility rather than monetary history. If silver follows this path, the ratio could compress dramatically, implying either much higher silver prices or much lower gold prices. The former is more likely given gold's own supply constraints. On February 2nd, 2026, the arbitrage gap between Shanghai and New York silver stood at $40 after accounting for VAT and shipping. This gap has persisted for 6 weeks. In normal markets, such opportunities disappear within hours as traders execute arbitrage. The persistence of the gap indicates that physical metal cannot move from west to east fast enough to equalize prices. Western vaults are draining. Registered COMEX inventory has fallen from 62 million ounces to 38 million ounces in 13 months. At the current pace, deliverable inventory depletes within 2 years. Lease rates of 8% signal acute shortage. Backwardation of $2.88 indicates buyers prefer immediate possession over future promises. China's export controls remove 35 million ounces from international markets. The United States, Russia, and Turkey are buying silver for strategic reserves. Industrial demand exceeds 600 million ounces and is growing. Mine supply is flat. 5 consecutive years of deficits have reduced free-floating inventories to 14 months of consumption. The silver market is transitioning from a financial asset priced by futures exchanges to a strategic commodity allocated by governments. This transition is not smooth. The January 30th crash from $121 to $78 demonstrated that exchanges will intervene to prevent delivery failures. But intervention cannot create physical metal. It can only redistribute existing supply through price manipulation and forced liquidation. Each intervention reduces confidence in paper markets and accelerates the shift to physical possession. The implications extend beyond silver. If industrial metals cannot be reliably sourced through futures markets, manufacturers must secure supply through long-term contracts with miners or direct ownership of production. This vertical integration increases capital requirements and reduces the liquidity that makes commodity markets efficient. Smaller firms without access to capital cannot compete. The fragmentation of global supply chains into regional blocks organized around strategic resource access becomes inevitable. The path forward depends on supply response and demand flexibility. If silver prices remain above $80, some mine projects become economic. But development timelines run 5 to 10 years. If industrial users can substitute copper or aluminum, demand moderates. But substitution requires redesigning products and accepting performance trade-offs. Neither supply expansion nor demand reduction occurs quickly. In the interim, prices will remain volatile and physical premiums will persist. The $40 arbitrage gap is not a number on a screen. It represents metal leaving London and New York vaults and accumulating in Shanghai and Hong Kong. Each 1,000-ounce bar that ships east permanently depletes Western inventory. When that inventory reaches critically low levels, European and American industrial users will compete for remaining supply. That competition will drive physical premiums in the West to levels that match or exceed Asian premiums. At that point, the paper price becomes irrelevant. Metal trades at whatever price secures supply. This is not financial advice. This is observation of market structure under stress. The structure is revealing that leverage of 370 to 1 cannot coexist with sustained physical delivery demand. One of two outcomes is inevitable. Either delivery demand recedes through price destruction and margin increases, or the paper system breaks through inventory depletion and delivery failures. January's crash attempted the first path. The persistence of 8% lease rates and $40 premiums suggests it did not succeed. The second path remains in progress. What cannot continue will not continue.